The IFA Show. The stories behind the financial advice headlines with the team from IFA.
Hello and welcome to the IFA Show. I'm your host, Keith Ford, and I'm joined today by Charlie Viola, who is the Executive Chairman of Viola Private Wealth. Welcome to the IFA Show, Charlie.
Thanks, Keith. Wonderful to be here, mate. How's things?
Doing very well. I'm not usually in the office on a Monday, so I've made a special trip for you, Charlie.
I'm honoured. Thank you for coming all the way in here for me, mate.
I did have one other thing, but we don't. I'll pretend that you didn't hear that. What I kind of wanted to talk to you about, we've been seeing a lot of talk around alternative assets, private markets being opened up. You've got the democratization of private wealth and private credit, private equity. Put private in front of anything and it's being democratized, right? So we've been seeing that a lot. A lot of the push being the idea that high net worth, ultra high net worth investors, they want to be able to access this. They've traditionally been the only people who can kind of access this, but it is being opened up to broader markets in many ways as a way to cater to those kind of high balance clients, people with a lot of investable assets, all of that, but also then kind of opening it up as a result to everyone else as well. You, of course, at Viola Private Wealth deal with high and ultra high net worth clients exclusively, I'm pretty sure, right? Can you talk to us a little bit about what you're seeing in terms of what clients are looking for on that private asset, that alternative asset kind of front, and where they're looking at things, how you guys are approaching it?
Yeah, sure. So we've been a user of private markets and private market assets, and we used to call them alternate assets. We no longer do that because people often think when you say alternate assets, you mean something that's really exotic. They think you're going to put them into a Guatemalan coal mine or something, which of course you're not. They're just very normal assets kind of wrapped up in a slightly different way. We've been a big user of alternate or private market assets for a long period of time. We're very fortunate with the client type that we have and our client base, where I guess if you're somebody who's got 5, 10, 15, 25, 50 odd $1 million, there's only so many CBA and BHP shares that you want to own, right? So it was really important that we kind of live to the theory of two things: asset quality and diversity. And as a result, we wanted to make sure that we were giving clients access to different types of investments, generating the returns in different ways, and making sure we were generating revenue for clients, especially through the cycle. So we've been a big user of that private asset market for a long period. There was very much once upon a time that it was very much reserved for small institutional, ultra high net wealth clients. There were lots of single asset style investments that were available or were only available to investors. What we've certainly seen in the last sort of 5 or 7 years is a real understanding that public markets versus private markets are actually very small. So the public market is very small, the private market is huge, and there is so much opportunity in that private market space. What needed to happen, though, is those really good managers in those private markets be able to bring to these kind of wholesale and sort of mezzanine style clients an opportunity to invest in those spaces. So where once upon a time it was all closed-end funds with a capital call structure and where money was kind of only used once, that's still available and that's still out there. But now there is much more the evergreen, semi-liquid investments. You use the word democratized, and that simply means it's available to many more people. So we're a big user of those. We have a view that client portfolios should be split between traditional public market investments. We will always have a sleeve for our alternate assets, which is really broken into two, and they being investment in what we probably call semi-liquid, evergreen, private market investments, and we will allocate money to, private debt, private credit, infrastructure, private equity within those, very much with a view of getting clients really good kind of exposure and allocation to those assets so that we can generate good medium-term returns and very much back the underlying managers to do a good job. We will always leave a sleeve for those opportunities that exist in the closed-ended funds. Some of those closed-ended funds give us access to opportunities that we otherwise don't get in the open-ended arrangements. but it is certainly becoming less and less for the simple fact that while we understand that those closed-ended funds are generally going to provide sometimes a better IRR, the open-ended funds, the evergreen arrangements, the semi-liquid arrangements, often because your money is invested for the entire time, you're often getting a better money on money return. So your time-weighted return is better than what it would be if you've got slightly larger IRR, but it takes a while for money to be invested, and then you start to get it back on the other end. So as an advisor, as somebody who allocates capital, we want to be invested. We want to be ensuring that we're allocating client monies to really good managers and to managers that we know can produce a really good return in the chosen asset class. And often the best way to do that is go and find the ones that have got good quality funds that are managing the money through the cycle and reusing the capital as they see fit within their kind of chosen market.
Yeah. You mentioned a little bit there around how many more options there are available, and it kind of struck me. It's a bit of a weird analogy, but it's kind of like gluten-free food, where back in the day, celiacs, they had very limited options for what they could have if they're trying to have like bread or something like that. Now, because it kind of got proliferated by a bunch of people who think that they're gluten intolerant alongside the people who actually are gluten intolerant, now there's a heap of extra options because people have tried to fill that market. Kind of a similar aspect, when you're trying to open it up to a whole range of other potential investors, you end up giving a lot more options, not just to those new investors, but also to those ones that were able to get in the first place. And you have more, more flexible approaches. They can pick something that's a bit more tailored to what they want, and you can pick that for them and show them this one would make more sense. Does opening it up like that make your life easier, or was it maybe easier when you only had to look at like 5 different things?
No, I mean, choice is always really good, right? So I think choice is always a double-edged sword. We work really hard on the due diligence process that we go through around manager selection, fund selection. There is obviously a danger that as you get more and more of this stuff come to market, you've got people not making the right decisions. But optionality is always fantastic. But also what we're doing is we're probably seeing some of those alternate options which were very much only able to people who could put in $500,000 lines or $1 million lines or often $10 million lines come down and enable us to invest at $100,000 or $200,000 lines, which, even for a client with, $15 million, $1 million in one asset or one type of asset is still a lot, and it's often still too much. So it becomes prohibitive. But where we can now access effectively the same asset class with the same characteristics for $100,000 or $150,000, it is a much better option. And we're seeing lots of this in the marketplace, right? Like once upon a time, groups like Hamilton Lane, KKR, whoever, was really only the space for institutional investors, family offices, etc. We can now access their product down at this kind of wholesale level for $100,000 or $150,000. And while it is semi-liquid, these investments are intended to be there over the medium to long term. They're buying real assets, or they're buying, real companies that are there to generate a return over a period of time. And that's certainly how we pitch it to clients and where we put it in their portfolios. It's just providing the access to them. The danger is that with lots of choice, there will always be ones that don't perform as well. And, so the due diligence process that we or anybody else like us go through becomes really important because ultimately you're backing the jockey. So the manager selection becomes super important, and therefore the due diligence process becomes really important. The normal kind of investment management theory is that asset allocation accounts for something like 85 to 90% of total investment return. We're a big believer in that. We're a big believer in not exposing all the clients' funds to one type of risk, which means that as we've seen kind of, traditional public markets roar their head off, it is incumbent upon us to reduce a bit of the risk out of the client portfolio and invest it in these other areas, even if it sometimes means they're missing out on some of the upside from the public markets roaring along, because what you're doing is you're just aligning portfolios back within a comfortable risk matrix.
Yeah, I guess some might look at it and, I've missed out on these potential returns, but you're not a a fortune teller. You have to do it within the risk tolerance and rebalancing along those lines, right?
The big thing is, and the matrix that we draw for clients every 6 months is to walk through, are you being rewarded for the risk that you're taking? Sometimes if you're generating these significant outsized returns, but you're taking a greater level of risk to generate those, that's not always a good thing. We're alive a very long time. We run portfolios with 50-year time horizons. We want to manage money within the risk parameters that the clients give us, and diversity becomes a really important part of that. And getting access to these types of investments, private debt, private credit, infrastructure, etc., private equity becomes really important in managing that risk.
Right. And those Guatemalan mines every now and then.
No, never. So we have one major screen. Well, we have 3 major screens for every investment that we ever put client money into. The very first screen is don't blow up your client's money, right? Because if we blow it up, if we buy things,
probably a good rule, right?
Yeah. If we buy things for $1 that turn into 50 cents, or we buy things for $1 that turns into dust, then we're probably going to lose clients along the way. But equally, that capital can no longer generate income. Our second screen is can we generate revenue out of that? So whether it's income that's being paid into the client's bank account or the underlying asset is generating revenue, we want to know that it's a good going concern. And the third one is we want growth, either capital growth or we want earnings growth, because we want to protect the buying power of the money. But the absolute first one is, are we going to blow up the client's money? As long as we're not, then we're happy to kind of move to phase 2, which is actually having a look at whether or not it produces those other characteristics.
Okay. I mean, as that very first thing, hurdle to jump over, not a bad idea. Just let's not just blow it up. We're going to take a quick break, and then I've definitely got some more questions for you, Charlie. So we'll be back in a moment. All right, we're back now. I've got Charlie Viola here again. Charlie, one of the things that you mentioned a little bit earlier on in the first segment was around, investors that have a lot of money, have a lot of funds that they're at their disposal to invest. They kind of run that concern of, well, I can't just buy like a quarter of CBA. I mean, that's a very extreme example, but that's the kind of thing that like super funds, the really big ones they've got a bit more leeway. They might be able to just buy up entire companies on the ASX and things like that. They're also looking for those other avenues to try and find returns for their members in a way that spreads it across different areas, more investment into private markets. There was Australian Super that had a private deal kind of blow up and make headlines and things like that. I think there was a collapse of an education services provider in the US. I'm going to stop because I forget the details of that, but that was kind of like a high profile, it's gone really bad in private markets. But if you look at like how much they're investing in all of these different ones, not that bad.
Yeah. I mean, the reality is risk mitigation 101 is diversity. So, we've all been told since, we all started in these games that don't put all your eggs in the same basket. And, to your point, that's actually been quite challenging for investors over the last 15 years because basically since GFC, we've had markets do nothing but go up, right? We've had equity markets roar their heads off. We've had emergency low interest rates. We've had asset values climbing away. We've had, mega tech companies where the multiples keep getting kind of bigger and bigger. We've had subscription businesses where you've got more and more people kind of, running to subscriptions and therefore kind of earnings numbers keep going up, but also forward earnings numbers and therefore multiples. Yeah. So for investors, it has often been a difficult conversation, or at least one where you have to have a deep conversation where why wouldn't we just keep buying, Australian banks, or why wouldn't we just keep, investing in the NASDAQ, or why wouldn't we just have gone and bought NVIDIA or what have you? And ultimately, while those assets have done exceptionally well for a very long period of time, it is purely around getting people back within the risk-return matrix, right? So now, the greater your exposure to one type of asset and one type of return and one type of thing that drives that return, the greater the risk you're taking. If you're taking that much risk, are you being rewarded for that risk, and can you handle the downturn if it occurs? So all we say to investors is that we can do that. We can keep buying CBA and BHP shares, or we can continue to just invest in, the kind of Mag 7, right? Yeah. But what we're doing is we're over apexing the risk that you're taking for the possible outcome. So what we would much rather do is generate a return that may well be 200 or 300 basis points below what that return might be over the short term, to generate a return that is slightly lower, but we're taking significantly less risks to do it. Therefore, our conversations with investors is that we want to have a 50-year time horizon with everything that we do. We want to be diverse. We want to generate returns in different ways. And if we give a little bit away on the upside by not taking the additional risk, that's okay, because by decorrelating our risk purely away from financial markets, we will end up with better medium to long-term returns. But it has been a difficult conversation where equities have basically done all of the heavy lifting, or a lot of the heavy lifting, over the last kind of 5 or 7 or 10 years.
And if you've had someone who's not listened to you, they've chucked everything into NVIDIA, it's hard to argue with them that they've made a wrong choice, right? Because it's done so well. And if you look at just from a return perspective, great work there. You've made a heap of money.
Yeah, we do. What we do when they're in the office and we draw the picture, we kind of put the dot, so far kind of top right that you can virtually not see it. And so this is where you're investing fundamentally. Yeah. So, and it's at that point, it still becomes incumbent upon people like us, where we're allocating capital for them, then cool, you've won. You were gambling, but you won. So let's bank some winnings and actually generate, a decent, good long-term return and stay rich. We talk to clients all the time. We are a stay rich business, right? Rather than a get rich business. And it is all about generating good quality returns through the cycle. The best way to do that is diversity, asset quality, but really important, like trying to invest within those kind of risk parameters that we sort of talk about all the time.
Yeah, stop putting the money on 00, move it to a different part of the board, right?
Well, the more, to use the roulette as the analogy, the more chips you have on the table, the greater the chance you are of returning. It dilutes your return. It's no different to investing, right? It increases your chance of winning. It dilutes the multiple that you're going to get on your money, but you are a far greater. And it's the same with diversity from an investment point of view.
Yeah, you want to spread. You don't want it all in the one spot. That's why they call it concentration risk, I guess. You mentioned a couple of times in there around picking the right fund manager. It's something that has come up like a million times. Anyone who is talking about anything private market, you have to bet on the fund manager, not on any of the other metrics. Fund manager, make sure they're solid, have a good track record, seem like they know what they're doing. Just what do you go through to actually make that? I mean, it's not a bet, it's not a gamble, but it kind of is. You are betting that they are good. What do you go through to determine that? Yeah,
you are absolutely backing the jockey, right? So where you're effectively handing money across to a manager into virtual blind trust, where you're trusting them to go and buy the right assets, do the deals at the right prices, exit at the right price, etc., then you are very much kind of backing that jockey to do a really good job over a long period of time. There's a couple of points to this. We have a really deep due diligence process that we go through, and I know lots of other groups like us and the asset consultants are exactly the same. And they often start with the CV and the pedigree and the historical outcomes over time. But we want to know process. We want to know screens. We want to know how they're choosing assets. We want to know what position they take in the company. We want to know how much of their own money, especially, is how much of their balance sheet or their own money is invested, or how aligned they are. A really key piece, though, is that old saying where past performance is no indication of beauty. It's a load of rubbish, right? Like it absolutely is an indication of future outcomes, because it goes to process. It goes to capability. It goes to how they screen assets. It goes to when they make decisions. What we always want to see with managers, we want to know when something didn't go right. So if they're a debt manager, a private credit manager, and they went and lent money against, a pub, and the pub burnt down, we want to know what happened when it all went pear for them. We want to know how they managed through that. We want to know how they're going to get our clients our money back and ensure the security of the capital. Or if it's debt and it has to step into the shoes of equity, we want to know how they've done that and what they've done. So we want to hear about the track record, and it's really important to us. in my experience of having done this for 20 odd years, I've never met a dumb fund manager, right? They are all extremely smart people and they are all incredibly unequivocal about their space, and that's great. They also are a little bit, I use this analogy a lot, they're also a little bit like, the second tradesman through your house. If you've ever had your house renovated or built, and the second tradesman walks in and will kind of look up top left and kind of go, who did that? That's rubbish. That's how every fund manager tends to feel about every other fund manager in their space. They always think that their processes, their due diligence, their term sheets, their screening process is better than everybody else's, right? Because they all think that everybody else is not as smart as what they are.
There's probably just one that is right every time. That yes, they are better, but you have to figure out who they are.
So we kind of have to look through what they're telling us and understand what they can actually show us.
Yeah.
So, we've built a really deep due diligence process because we expect them to turn up and be really unequivocal about their space, tell us why they're the experts, etc. Ultimately, though, we want to see a track record, and that track record around dealing with difficulties within their underlying client base or their underlying asset base becomes really important. But also we want to see alignment. Alignment is a big one for us. How much are they willing to eat their own cooking on this stuff? And secondly, we don't want to be a passenger to a manager just generating a return to get fees. We want to know that they're completely aligned with us in terms of the upside result because, otherwise it's just dealing with other people's money. So, we never want a manager whose whole business model is around generating a return from the fees being earned from other people's money.
Right. And I guess if you're going into an active management situation, fees are going to be higher. They also have to outperform whatever would be passive by as much that the fees are no longer, they don't eat into the returns.
Yeah. So we don't do a lot of investment into active management on public markets. We think that's actually really hard for managers to and there are some really good ones who do a really good job. We're a big investor in, some global equity funds like Aorus's fund and Loftus Peak and a number of those who can genuinely add value and have added value over time. In terms of the private market space, remembering we're looking at assets that otherwise you generally can't get to on a one-on-one basis. You can't just go and buy a portion of a Chinese toll road or, you generally can't go and buy a
There's probably an ETF for that by now.
Yeah, there probably is. I mean, it's difficult to go and invest in a, utilities company out of Perth that are, servicing the mining. We're expecting infrastructure, funds and stuff to kind of do that for us. We understand, and the discussion that we have is there's no false economy, right? So if they're going to generate outsized returns for us, we expect to pay fees. We're okay with that. We're okay to commit client monies to those on the basis that they can display that they can actually generate those outsized returns for us.
Yeah. And, the point of having a bit of alignment in there as well makes a lot of sense because,
alignment is one of the really key pieces for us, especially with boutique managers. So if we're talking to, Partners Group or KKR or Hamilton Lane or what have you, we're talking about, huge groups with huge amounts of funds under management, with huge resources to kind of throw at this stuff and a huge level of pedigree. Once was an investment banker, now as a fund manager kind of thing. You've never seen so much kind of, proliferation of funds management skills in the market where everybody kind of is doing it. Those boutique managers have to be aligned. We need to know that a good portion of what's in the fund is their own personal balance sheet because we need them to treat our clients' money like it's their own.
Yeah. I don't like how frequently I'm coming back to gambling analogies with this. It's because it is very distinct from gambling. It is not the same because you can, maybe professional gamblers would disagree, but it's the kind of thing where you find there's a billion podcasts of people giving out what their gambling expertise is. And no one who's actually good at gambling would ever give their tips away because then you've just got the public riding you and it reduces the odds for the bookmakers and you then end up making less. No one who's actually good at that would ever be doing it this way. So anyone who's telling you should disregard anything they have to say. And it's just like makes it a bit of this problem area where you can't really listen to anyone who's saying anything public because they wouldn't be saying it public if they were really good.
Yeah,
Similarly, if you're aligned,
I think I understand where you're going with this.
if you don't have the trust in your own process and what you're doing to have your own money in it, then why would we trust what you're going to do? It's kind of where I'm getting at.
My experience is the best fund managers will tell you that they don't have a secret sauce. My experience is that the best fund managers with the best processes will just tell you that while there is a little bit of qual, most of it's quant. And in lots of ways, most of them will tell you that there's no crystal balling, there's no secret sauce, there's no rocket science applied. There is a good, normal, sort of quantitative process that they go through to come up with why, what they're buying, what they're investing in, who they're backing, how they back founders. The process is all very formulaic driven. And that's what we want to hear. We want to hear that they have a simple, proven formula for choosing the right assets, choosing the right founders that they're investing in, choosing the right companies, choosing whatever it might be. And most of them will tell you there's no rocket science to any of this. We'll go and follow this process and that will deliver returns over time because fundamentally it has to, and historically it has. So if we go and buy a growth company that has got a certain amount of market share, that knows it can grow that market share and knows that it has a distributable product to allow it to grow its earnings, we know that over time as it builds scale, it's going to get multiple expansion. All we're banking on is that the founder continuing to do what they said that they were going to do, increasing their market share, and then we'll benefit from the multiple expansion. Therefore, we're happy to go and buy that company. They're the things that we want to hear from the managers when they're going and putting money into these companies. We don't really want to hear that, we have this kind of secret way of doing it, that we've got the sort of 11 herbs and spices, and in doing so, that's produced an outcome over time. That's not quantifiable for us. That's not a way that we would ever make a decision around making any investment. We want to know what your process is. We want to know what it is that you're looking at. We want to understand the quant. And while there will always be a little bit of a qualitative assessment, that the founder's a nice guy and has got, a really good kind of reputation in his market or his sector, the reality is we want to see hard data for how those decisions are being made.
Yeah, just show me where your maths PhD is over in the corner office there in the dark, just going through the numbers.
Yeah.
We're going to take another quick break now, Charlie, and we'll be back with more. All right, we're back now with more from Charlie Viola. Something that we've seen a lot of, which is kind of what prompted me to kind of ask you about some of this, is that we've seen a lot more targeting of these kind of assets through different structures, whether they be, an MDA or whatever it is, some kind of managed account, being targeted at a larger retail audience. And that's not the way that you go about things at Viola. You have a chief investment officer, which is not something that is going to be, most advice firms aren't going to have that kind of, position in there. Do you think that for firms that don't have that as part of their offering, maybe not targeting the high, ultra high net worth clients, that going with those managed account options that are being provided through a range of different people at this stage, opening it up, is that a good option? Where do you see the differences between the two kind of approaches?
Yeah, I mean, we are very fortunate. We have our own CIO function. Our CIO, Daniel Kelly, is, in my view, one of the brightest minds in the private wealth world. And, he's a super smart guy who, I think for fun, he tutors other people doing the CFA in his spare time. So so we're very lucky in terms of how we do our due diligence, the fact that we do it all in-house. For groups who perhaps don't have, the resources that we do, or the sort of the amount of funds under management that we do, clearly the reliance on the asset consultants over the last sort of 5 years has grown. And whenever sort of I turn up to industry events, it is now full of asset consultants, and those guys do a great job. They're deeply resourced. They've got a number of different advisory groups as clients, and therefore it's kind of a pooling of resources to be able to do the due diligence. They work really hard in terms of, from my understanding, that they work really hard in terms of how they review managers, how managers end up in their SMAs. And while once upon a time it was about putting together mainly public market SMAs and public and mixed portfolios from a public market point of view. So choosing a Platinum or a Magellan over a whoever, it has very much moved now into this private market space. And my experience in talking to these asset consultants is they are kind of there is a real deep level of knowledge from those guys in the public market space. I think now every advisor will know that asset allocation is really important. We all do risk profiling for clients. So whether the client comes to us with 30 or 50 or $100 million, or they're going to a retail advisor, we're still risk profiling them. We're still working out how what their tolerance levels are. And for those guys, having access to the asset consultants, having access to pre-mixed investment options is really important from a diversity point of view. And now there is way more access to those, to use the word again, democratized private market assets in those semi-liquid structures within those SMAs. So, I'm an investment nuffy at my heart. I like the work that the asset consultants do. They've worked really hard to bring down the level of entry because they're effectively aggregating funds or they're pulling together funds. They can go to some of these wonderful managers, some of the best managers, and say, hey, we can't give you line items of $500,000 or $1 million or $10 million, but hey, we could absolutely commit across the 15 or 20 or 50 advice groups that we look after. We're going to have deal flow that will end up being $100 million over a 12-month period. You just need to allow us to access your product. And that gives lots of clients and lots of advisors with lots of clients great access to those things.
If you were to not have your, have Daniel Kelly as part of your business, you didn't have a CIO, what would you be looking at for one of these asset consultants in their process, similarly to how you evaluate a fund manager? What would you look at from their perspective?
Yeah, I think it's probably a little bit the same. I think it's the due diligence process around who's helping you choose those investments is, what is your pedigree? What is your past? What are your relationships? We absolutely want to know that their relationships are such where they can give access within those SMAs to product that either others can't or they're not being left behind compared to their sort of major competitors. Ultimately, we all just want to do a really good job for our clients, right? We just want to make sure we're allocating capital to the right areas at the right time. Therefore, we want to know that the asset consultant that we're using understands what we're actually trying to achieve. You meet the odd asset consultant who is just wrapped in theory and doesn't understand that there's a client on the other side. My first question is how many times have you actually had to face a client? How many times have you actually had to have a conversation with the client rather than the underlying theoretical? Because, we actually have to manage clients' money, right? Like we actually have to make decisions around when things have to change. If somebody else somewhere else is just constantly going, oh, now we need to kind of shave 10% of the infrastructure exposure and stick it into equities, well, that's not real life, right? Like just making changes to client portfolios like that isn't real life.
Yeah.
So we want to know that they've got some very real world experience in terms of, how they're actually putting their strategies together and the time for change, etc. But ultimately, we want to see what their due diligence process is in choosing managers. We want to know that they are agnostic in terms of who they're choosing and that there are no, there's no conflict in terms of which managers they're sticking into their models over a period of time. And we want to know that they're keeping up with like the market theory piece. We want to know that we want to know that they're understanding of what we're trying to achieve. So if we want revenue from client portfolios, then we want to know that they're kind of listening to that and they're building those portfolios with the context that's right, sort of thing.
Yeah. For you, what do you think is the biggest issue in financial advice at the moment? It can be most concerning, most interesting, wherever you want to take it. But what do you think is the biggest issue?
Oh, my answer might end up being controversial if I tell you the actual truth.
Perfect.
I actually emceed a conference the other day, and one of the sort of survey questions was, what's the greatest issue in financial services.
We outsource the answer here.
Yeah. But one of the options, and it was, access to talent, access to product, and one of them was growth, right?
Right.
Of the 100 people who responded to it, growth was zero, right, as a concern. And the reason being is that these are fantastic businesses to work in, to own, because you've got more people who need it, you've got more people getting wealthier, and you've got less people who actually do it, right? So they're great businesses to own. So the problem is, and therefore, me as a high net wealth, ultra high net wealth advisor, or our business doing that, we're not really competing with anybody. People say to me, who do you compete with? And we go, well, nobody really, because there's enough clients for everybody. The problem we have, or the problem in our world fundamentally, is that we all want the same type of client. I think if we're all being really honest, we all want the client with $2 million to $100 million, or $2 million to sort of $200 million. We all find it commercially because of regulations, staff costs, whatever, compliance costs, governance expense. We all find it hard commercially to look after people with 3 or 4 or 500 grand, right? So we all want the same type of client. There is a significant cohort of clients who we need to find a solution for those people. And again, probably controversially, I think the industry funds, and I think that some of those kind of major aligned or vertically integrated institutions have got a real opportunity and job to do for that mass affluent space. Because especially where the major asset that's being looked after is the super monies, I think there is a real opportunity for those, especially the industry funds, to look after that mass affluent space that genuinely needs help, genuinely needs someone to do the planning for them around, how long does it take for me to pay my mortgage off? How much insurance do I need? How much should I be contributing to super? Because it's difficult for someone like me with my cost overheads and the types of clients that we want to be able to look after those clients, right? So the biggest issue is putting enough resources and enough regulation into those vertically integrated organisations to enable them to service that cohort of the market, but do it in a really effective way that really benefits them. Like AMP used to do that, right? That was their market space. And while maybe some of the vertical integration and the conflicted revenue REM wasn't right, they absolutely did service that part of the market. We need to come up with a way of servicing that part of the market and ensuring that Australians are getting really good advice around, kind of debt reduction, wealth accumulation, insurance needs, super contributions. And then ultimately everybody needs to be comfortable that when the client's got more money and needs more sophisticated investment advice, that it can come to our part of the market.
Yeah, I guess it's just a matter of finding what the balance between the regulation and opening it up actually lands on, so that it is done in a way that, you don't end up with some of the issues that
we had in the past.
Hopefully, best interest duty, all of that helps with.
Yeah, correct. I think what's happened though is turning the industry or turning the profession around was like trying to turn a massive tanker around, right? It was like trying to turn the QE2 around. It takes a while. But while some of the regulatory changes and some of the education standard changes and stuff were a bit annoying, and they were annoying to someone like me, right? I had 20 years experience, and suddenly, I was less qualified. A year or so ago, I was less qualified than what somebody who'd finished university a year or so ago. And, I'm considered one of the best advisors in the country, and yet I still had to go and do a bridging course to get myself qualified, right? That doesn't seem right. But what it does do, or what it has done, is increase the quality of people who have come into the industry. Some people who didn't want to do the education gap stuff and didn't want to meet the current education standards have left, and some of them we're probably happy that they've left. But what it's brought now, because of university choices and the way we get paid and the types of businesses that we run, it's meant much better people are coming into the industry, and that's a great outcome. And while maybe whether that was the plan and that was the strategic intent of all the changes, I'm not sure, but that's the impact that it's had, which means that we've got much better advisors. They're much more qualified. And whereas previously we couldn't compete for talent with, law and accounting and engineering, we now do. And that's where Australia is going to get their advice from some of the smartest, people coming out of university. And that's a great thing.
Yeah, I guess just you need enough of them so that there's enough advisors
Yeah.
that can even look after the people that aren't going to be able to be done in that lower
Yeah.
kind of bracket.
But remembering that we have these really significantly sized and outsized industry funds that make a huge level of revenue that can cater for lots of that stuff. Because ultimately, if you've got 300 or 400 grand in super, or 500 grand in super, being invested in that kind of homogenous way is actually a good outcome, because you're getting good quality managers, good quality due diligence. It's very heavily regulated. You're getting access to infrastructure assets and private equity assets and all sorts of stuff. There is enough choice without being the misery of choice within there, and you're not being belted on fees. So in reality, that cohort should be being looked after by that type of organisation. And then when people want to take a greater hold, when people want to have greater optionality or want to take advantage of what's available in our part of the market, that's the point to go and get advice of someone where you're then willing to pay for it because you've got the means to do so.
Awesome. Well, thank you very much for your time today, Charlie, and hopefully you've enjoyed coming on the show.
Thanks, Keith. As always, pleasure, mate. Thank you.
Awesome. And thank you very much to the audience for having a listen and hearing what Charlie had to say. Hopefully you enjoyed the show, and we'll see you again next time. Bye for now.